Hi all, here's another video. This one's on exercise 10.23, E10.23. It's on page 10.59. This one is on the three different models. The question only asks for fair value and cost model, but I'm going to do part C, revaluation model as well. Typically, if I look where students have issues in this chapter, it's with the revaluation model, or the comparison of the three models. Non-monetary, which, we did a couple of questions on that in class, and the assignment, there's quite a large question. And then other than that, it's really just, what gets included in land building and whatever, and we've done quite a few exercises, and there's a lot of practice in the textbook on that. So let's look at E10.23. Let you guys give it a read, but essentially what we have is we built a mall, we finished it December 31, 2019, and it cost us $50 million. So, in all circumstances, we're going to start with this journal entry. Debit PP&E 50 million, credit cash 50 million. Again, right? We built an asset. That PP&E account, there's a number of different things you could call it. I mean, you could call it the mall, you could call it the building, you could call it investment property. Basically something that describes what the asset is. And it's an asset. It asks for the fair value model, and of course then we have appraised values as at the end of the next 4 years. Right, we built it in 19, we have appraised values 20, 21, 22, and 23. So first they ask for the fair value model, and I hate using the term easy because I don't want to talk down, but when you see fair value, there's fewer entries, there's fewer calculations, and it should be the one that's the most straightforward to you. One, there is no depreciation recorded, so you don't need to do that calculation. And two, you just need to adjust the PP&E balance to fair value at every period end. And the difference is going to be a gain or a loss. Okay, so how I would do it in this type of question, I've set up the PP&E T account here. I have dropped in, right, here's what we started with. Here's the appraised value at the end of 2020, so that's what the account balance needs to be at the end of 2020. And 2021, and 2022, and 2023. Okay, so all we need to do, we need to record an entry to force the PP&E account to be the fair value. So in 2020, there is no entry because it's still at 50. In 2021, I need a $10 or $10 million debit to PP&E to make the balance work, right? To go from 50 to 60, I need to enter 10. So there's my entry. Debit 10. And the credit is to a gain. The offsetting account here, gain, loss, whatever. Titles I'm not too fussy about, and if you just use the word gain, that is fine, but gain on PP&E, gain on fair value change, gain on investment property, those would all be acceptable account names, as well as a number of others, as long as it properly describes the transaction. And again, I think easiest is just say gain. Okay, so 2021, we adjusted it to 60, 2022 comes along, now the appraised is 63, so we're going to need an entry for $3, same as this year. 2023 comes along, and now the appraised value has gone down. Now it's only worth $58 million, but it's the same math. I need to get the account from 63, which was last year's fair value, to 58, which is this year's fair value, so I need a credit of 5. What color should we use for that? Orange. So that would drive this entry. Again, I'm recording the entry to PP&E, but now it's a credit, so my debit account is going to be loss. Gain / loss, loss on PP&E, loss on fair value change, any of those are fine. Okay, so fair value should be pretty straightforward. I hope. Cost model. Well, the cost model is the normal method. It's what we're used to. It's what you would have taken in Accounting 102. Essentially, we're not going to adjust the property, plant, and equipment account unless it's impaired, and we'll cover impairment in Chapter 11. And we're just going to record depreciation annually. So to review the depreciation calculation, typically for straight line, it's going to be cost minus residual value divided by the useful life. So in this example, we've got a $50 million asset, $10 million residual, they gave us that in the question, and it's got a 20-year life. So 50 minus 10 is 40, divided by 20 is 2 million per year. So every year, 2020 through 2023, I'm going to book this same entry. And that's it. And if I looked at the carrying value of this asset, or what it's on my books for, at 2019 it's up on there for 50 million. At the end of 2020, well, I booked 2 million in accumulated depreciation, so now the carrying amount is the 50 in the cost account minus the 2 in the accumulated depreciation is 48. And the next year it's 46, and the next year it's 44, and it's going to go down and down and down over the 20-year life. So what we're used to, good review of 102, and yeah, just standard depreciation entries you need. The revaluation model, which again isn't in the question solution, again, because everything can't be easy, this is where you go from your C plus or B minus to an A, because you can get these entries. The steps I recommend, I should mention, we will not use the proportionate method. They talk something about the proportionate method in the text. I think it's actually in the appendix, so we don't cover it. We're just going to adjust the fair value. So a few things to remember. One, make sure depreciation is recorded every year. Under the revaluation model, you need to record depreciation. And on some sort of regular basis, you're going to get new fair values, and at those dates, there's a couple of steps to go through. One is you should adjust the accumulated depreciation account to 0, and the opposite side of that entry is going to be to PP&E. Now, this is a bookkeeping kind of thing and a method, but I think it's the easiest one to follow. If you want to do it differently, as long as you get to the right answer, I'm fine. So then you want to adjust the PP&E to its fair value after considering this line. And then always remember, in the future, you're going to recalculate your depreciation because now you have a different book value, right? You have a different carrying amount. Now, revaluation is different than fair value. If you're using the fair value method, you have to revalue every year end, right? Find a fair value at every period. Revaluation, you only have to do it regularly, I think is the term they use. So let's assume the only revaluation we are going to have is at the end of 2022 when we go and get the property appraised at 63 million. Okay? This would be a good time for you guys to go through and try the math before you look at the rest of this, but let's assume you've done that. So first things first, I still have to record depreciation. 2020, 2021, and 2022, record my depreciation expense same as above. Right? Make sure it's recorded in 2022 before you do the revaluation entries, because the revaluation essentially happens on the last day of the year. So if I look at my account, there is what is sitting in it. Right? 2020 I booked 2 million, 2021 I booked 2 million, 2022 I booked 2 million. 2022, after I book the depreciation, I need to set this account to 0, so I need a $6 debit. And that brings the balance to 0. Okay, so that is this entry. And that is this entry. Then I need to come along and I need to force the PP&E account, same as in the fair value method, to be 63 million. How do I do that? Well, the account's sitting at 50 minus 6 right now is 44, so I need a $19 million debit. That's going to go to PP&E. And the opposite is this long name that you have to remember, revaluation surplus, OCI. This is other comprehensive income. We will cover this quite a bit in chapter 4. We'll see the terminology a little bit before that, but trust me, it's not really income, but it's kind of income, and we'll go over what it is later, but that's the account it goes to. Okay, and then the only other thing that changes in 2023, now I need to revise my depreciation calculation. And in this case, it's not nice round numbers, but I didn't want to put zeros on everything. How much is it? Well, my new value of the asset is 63 million. My residual is still 10 million, so the amount I want to depreciate is 63 minus 10. But now there's only 17 years left in the useful life of this asset, right? Had a 20-year life, 3 years have gone by, so divided by 17 years means now my depreciation is going to be 3,117,647 per year, and I've just kind of rounded it here. Okay, that's the revaluation model. That is the 3 different models we have. If you can be familiar with those, the practice exam question looks at this as well, plus what we went through in class in the handout. So good luck. Thanks.